Okay. Well, I'm Paul Dittman. I'm with Compeer Financial. Compeer Financial is part of the Farm Credit System, which is a nationwide network of farmer-owned, farmer-led cooperatives that provide financing and other services to farmers. My specific role here is I run our Emerging Markets Loan Program, which is a loan program for farmers who market their products directly to consumers or do something in value-added agriculture. So I'm going to talk a bit about loans, leases, grants, business planning today, not necessarily in that particular order. I'm also joined by Dylan Bruce, and Dylan is co-owner of Circadian Organics, which is a farm, and then he and his business partner, Cody Egan, started a company called Driftless Seed Company a couple of years ago. And so, Dylan's gonna give his perspective towards the end of the presentation on the lending process and business planning and all that sort of stuff. He's got a wealth of knowledge. So, and Dylan, I think, are you still on the Marble Seed board?
I am, yep. I'm the secretary of the Marble Seed Board.
Okay, great. So yeah, I really appreciate you taking the time to join us today too.
Yeah, happy to be here.
All right, so what we're going to cover today, I'm going to give you some basic information about farm loans. Farm loans are a little bit different than consumer loans. I'll explain the difference there and the different types of farm loans, what they're used for. We'll talk about how to get ready to apply for a farm loan, how a lender looks at a loan application and processes a loan application. And then I want to cover kind of a broader range of different farm financing options. So not just loans, but maybe getting financing from other sources as well. We'll talk about some grant opportunities that we have here at Compeer for small scale farmers and also for rural communities. I'm going to touch on business planning all along the way. So I don't have a separate section that just talks about business planning. I'll be talking about it as we go. And then, like I said, we're going to get Dylan's perspectives on all the things that we talk about here today, his perspective as a farmer, but also as a business entrepreneur. So farm loans, to start with, are commercial loans. They're not consumer loans. So as commercial loans, it's like any other sort of business loan. It's looked at a little bit differently in the market. Commercial loans typically have a little bit higher interest rate. They're considered to be riskier than consumer loans. A consumer loan would be a loan for a personal vehicle or for a personal home, that sort of thing. Farm real estate loans generally aren't sold on the secondary market. So there's most of the home loans, consumer home loans right now, something like 95+% of home mortgages are sold off on the secondary market to either Fannie Mae or Freddie Mac. And by doing that, the local bank is essentially passing the risk of that loan default onto the market. That's why they can offer a 30-year fixed rate mortgage. And the local bank will continue to service it, but you may not even know that your loan's been sold, but it's been sold off on the secondary market. Because there isn't that secondary market, there's something called Farmer Mac. Farmer Mac isn't, well, we certainly don't utilize it very much in our system. Some commercial banks do, but they typically only do that with larger loan packages. There are a lot of fees and things like that, so I don't know a whole lot about Farmer Mac. But so because there isn't a very commonly used secondary market in the farm real estate loan market, a lot of banks and credit unions won't finance farms at all. The ones that do will typically only offer either a 3-year adjustable rate or a 5-year adjustable rate, which means that the interest rate is locked for 3 years or it's locked for 5 years, and then it's going to float to whatever the current market interest rate is. So there's the borrower has a fair amount of interest rate risk exposure there because they can't really lock that rate longer than 3 or 5 years. Interest rates, like I said, are typically higher on a commercial loan. On a farm loan, they're going to be 1 to 1.5% higher. So if you hear on the radio that 30-year fixed rate mortgages are at 7.2%, 30-year fixed rate farm mortgage is probably going to be more like 8.2%. It's going to be at least 1% higher. And by the way, if you have questions as we go along here, please feel free to put those questions in the chat. Sarah's going to monitor the chat and interrupt. I'm happy to be interrupted at any point. I'd rather answer a question as they come up than to wait to the end and maybe you're not following what I'm talking about or whatever. So please feel free to use the chat, and Sarah will break in, and I can answer questions along the way. So there are basically three types of farm loans. There's operating loans, there are intermediate term loans, and there are long-term loans. Operating loan is typically used to cover operating expenses during the production year. So you take an operating loan, you tap it as you need it, you use it to pay for inputs, you use it to pay for land rent, other things like that. And then once you have income from the farm, then you pay the operating loan back with your farm income. We've been using operating loans also to gap fund grant expenses. So let's say you've got an EQIP grant on your farm and you have expenses that have to be paid up front. You get your project done. You apply to the Natural Resources Conservation Service for reimbursement. By taking an operating loan, you can cover those bills as you're waiting for that reimbursement from NRCS. And so you get the reimbursement, you pay off the operating loan. With an operating loan, they tend to be pretty flexible. There really aren't any regular payments, generally speaking. So you use it when you need it, you pay it back when you can. When you pay it back, you're paying the principal and the accrued interest at that point. It's supposed to be paid off with farm income as the farm income becomes available. And we like to see an operating loan get paid down to zero at least once a year. We like to make sure that it is revolving. What we don't want to see is someone gets an operating loan with us and they run it up to the limit, don't pay anything down. A year later, it comes time for renewal. That's going to be really tough for us to renew the operating loan at that point because it hasn't performed as it's supposed to. It hasn't revolved. The interest rate on an operating loan is variable. So that means it can change on a monthly basis. Typically follows the federal funds rate. So if the Fed, they're talking right now about lowering interest rates next month. If they implement a 0.25% interest rate cut next month, the rate on our operating loans on October 1st is probably going to go down 0.25% too. It goes the other way too, though. If the Fed raises rates, our rates are going to go up as well. A lot of the farmers that I work with, and I lead our emerging markets program, a lot of the farmers I work with are relatively small scale. A lot are first generation farmers. A lot haven't been farming for very long. They start pretty small. They're putting things on credit cards and they don't really get to the point yet, at least the first few years that they're in business, of going to a lender and taking an operating loan for the farm. And they're trying to fund the farm with credit cards. And that's very common, not just in agriculture. It's common for businesses outside of agriculture when they get started to use credit cards as their source of working capital. But this is why you shouldn't use credit cards as your line of credit. The average credit card interest rate right now is about 21%. You get your credit card statement, you'll see that there's a minimum payment required, right? And that minimum monthly payment is typically 3% of the outstanding balance on that credit card. So if you've got a $5,000 balance on your credit card, 3% of that is $150. So that's going to be your minimum payment, $150 per month. If you only make the minimum payments and you never put anything else on that credit card, so you take a balance of $5,000, you don't add to it, you're making that minimum monthly payment of $150, it's going to take 4 years and 2 months to pay off that $5,000 balance at $150 a month if the interest rate's 21%. In that 4 years and 2 months, you're going to pay a total of $2,565 of interest. If you had a farm operating loan, let's say you took a farm operating loan, you took a $5,000 balance on it. The operating loan right now might be about 9%. Actually, it's a little on the high side. We're probably going to be closer to 8 right now. And you still made that same $150 a month payment. It's going to take you 3 years and 2 months. So you'll pay it off 1 year sooner than you would have paid off the credit card balance at the $150 a month payment. And in that 3 years and 2 months, you would have paid $773 in interest rather than $2,565. So it makes a significant difference. So I would encourage you, and this isn't a sales pitch for Compeer, go to whatever lender you're comfortable with. If you want to work with your credit union, your local community bank, that's great. Take an operating loan for your farm, even if you don't think that you really need it. So that's all about operating loans. Any questions there? I'll pause for just a second. Okay, if not, we'll move on to intermediate term loans. Intermediate term loans are typically for a term of anywhere from 3 to 7 years, and they're used to purchase equipment. They're used to purchase breeding livestock. Could be used for movable buildings like a hoop house, that sort of thing. Term of the loan again is up to 7 years. Typically, we can sometimes go up to 10 on an intermediate term loan. Term loan will have regular scheduled principal and interest payments. So it's going to be a fully amortized loan. You'll have a monthly payment, quarterly payment, semi-annual or annual, but those payments that you make, it'll be a combination of principal and interest. An intermediate term loan could either be on a fixed interest rate or it could be on an adjustable rate. So we can do a 3-year adjustable rate machinery note with a 7-year amortization. It's very rare. I almost never do an adjustable rate intermediate term loan because there isn't much of a difference between the fixed rate and the adjustable rate. Right now, just to kind of give you a sense, the interest rate on an intermediate term loan for a piece of equipment is going to be in the 7 to 7.5% range. We're in kind of an interesting interest rate environment. You heard me say on the operating loan, 9%, maybe down to 8%. And here we're talking about maybe a 5 or 7 year loan for a piece of equipment at 7 to 7.5. Why would the interest rate be lower on a longer term loan than on a short term loan? Just a weird interest rate environment that we're in right now. If you've heard economists talk about an inverted yield curve, that's what's going on right now, where the short term rates are higher than the long term rates. And it's just because the Fed has, they raised rates trying to tamp down inflation, and they haven't lowered those rates, but the bond market is anticipating the rates are going to come down over time, and so they're pricing that into the longer term.
Quick question.
Okay. I'm sorry. Go ahead.
It's my own. So when you're arranging the terms of a loan, an intermediate sort of loan, how much does the length of the loan generally, outside of this strange environment, how does the length of the loan affect the rate that you pay?
Usually, the longer the term, the higher the interest rate, and sometimes that it can be a pretty small change. If you go from a 5-year to a 7-year, it might only be 0.1% or 0.2%. Mm-hmm. So it generally isn't. It's not a huge difference.
Okay. Thanks.
Yeah. Long-term loans are used to purchase real estate or buildings. Term of the loan there can be up to 30 years, and that'll have scheduled principal and interest payments. There'll be amortized payments where every payment you're making some principal and some interest. Payments, again, could be monthly, quarterly, semi-annual, or annual. Long-term loans can either be on a fixed interest rate or an adjustable rate. And like I mentioned, a lot of banks will only do a 3-year or 5-year adjustable rate mortgage on real estate for farms. We'll do up to a 30-year fixed rate on farms. It's a bit unusual, and we do that without selling the loans off on the secondary market. We keep all of our loans in-house, but it's just because of the funding structure of the farm credit system that we're able to offer long-term fixed rates on farm real estate. So I want to just touch briefly on the program that I lead here at Compeer, which is the Emerging Markets Loan Program. And it's for farmers who live within our territory. We're in 144 counties across Minnesota, Wisconsin, and Illinois. So our program is for farmers in our territory who market their products directly to consumers who are engaged in value-added agriculture, whether it's value-added production, processing, or marketing. The Emerging Markets Program, we have a micro loan. That's sort of the entry point to our program. That's up to $75,000. So we can write loans in our micro loan from $5,000 to $75,000. Pretty easy underwriting standards. We try to give people a really quick loan decision. So if you apply for a loan today, we can probably give you an answer tomorrow. And once we have the loan approved, we get the loan documents put together, signed, and we fund the loan right away. So we can, if we get a completed application on a Monday, we can typically be handing a check to the farmer by Friday. Interest rate here is a little bit lower than on the rest of our loan programs because we carved out a pool of capital when we designed the program, and then created a set of underwriting standards that, as I mentioned, are a bit easier than in the rest of our loan program, so that we can do things that the rest of Compeer really can't do. We do a lot of business planning here too. A lot of times, as I mentioned, our clients are first generation farmers. They didn't come from a farm background. They don't have a family farm net worth position to fall back against. You know, they don't have someone taking care of paying their bills and that sort of thing. So it's our folks they're starting out, and and sometimes they're running pretty close to the bone, and so we're trying to help them with business planning along the way too, so that we're there when they need the $5,000 operating loan. We're there when they need a $50,000 loan to buy some equipment, and then we're still there when they buy their first farm. You know, so we're really trying to help people get on top of the business side of farming. So that's a little bit about the Emerging Markets Program. Any questions about the types of loans? I'm going to get a little bit more into what it takes to get a loan, how to prepare for a loan, how we look at making a loan decision, that sort of thing. But any general questions about loans? Okay, if not, I'm going to talk about grants, and I'm going to talk specifically about the grants that we have available here at Compeer. There are other grants that are available to LFPA farmers. It could be the Buy Local, Buy Wisconsin grant program, which is offered through the Wisconsin Department of Ag, Trade, and Consumer Protection. Could be the North Central Region Sustainable Agriculture Research and Education Farmer and Rancher Grant Program, which is an excellent program offered in the 12-state region of the Upper Midwest. But I'm going to, for today's purposes, I'm going to specifically speak about our grants that we have here available at Compeer. You can find information about all of our grants at this website. If you just go to compeer.com, investing in rural communities, giving back, and then grants, you'll find the whole list of grants that we have available. I'm just going to touch on some. There's more than what I'm going to talk about here today. The first one I want to mention is our Beginning with Compeer grant. This is available to any beginning farmer that lives in our territory. You don't have to be a young beginning farmer. You don't have to have a loan with Compeer. You don't have to have any business relationship with Compeer at all. You don't even really have to be farming. If you're planning to start a farm next year, you can apply for our Beginning with Compeer grant. If you don't have any business with Compeer at all, you can get $250 under that grant. If you have a Compeer loan and the balance is less than $50,000, the grant is $500. And if you have a loan with a principal balance of more than $50,000, the grant is $1,500. The grant funds can be used for a lot of different types of business purposes. Conference registration is a big one. We've sent a lot of people to the Marvel Seed Conference over the years using the Beginning with Compeer grant program. People have used it for the Grassworks Conference, for a number of other things. You could use it to buy farm accounting software, so QuickBooks or another type of farm accounting software. You could use it to hire an accountant to help you set up your chart of accounts or to help you with your income taxes. It could be used for marketing expenses. You could use it to help design a label. You could use it for an attorney to help you create an LLC. So there's a lot of different business purposes. The idea of it is to help you with the business management side of farming. Funds can't be used for purchase of equipment and can't be used for normal operating expenses. Those are the couple of restrictions on it. It's a very simple application process. It's not competitive. It's open all the time. So if you go to the website, it's an online application. It's like 2 pages and half of that is just your name and address. If you apply, you live in our territory, there's a very, very good chance you're going to get the funding. So I encourage everybody to apply for that. Tell your friends about it too. We always want to see this program utilized more than it has been. That's the Beginning with Compeer grant. We also have a farmers market grant program. This one is only available to our loan clients. So for this one, you do have to have a loan with Compeer. It's also available to public farmers markets that are located within our territory. The client grant is $500. The market grant is $1,000. The funds here are a lot more flexible. You can use it for pretty much anything that you need at the farmer's market. So if you need a new scale, you could apply for the grant for that. A pop-up canopy, for displays, for signage, for advertising, other types of marketing materials. If the market wants to do surveys of clients or do some radio promotion or whatever, they could use the grant funds for that sort of thing. During COVID, we included things like hand sanitizer stations and things like that that could be funded under this grant. The application period for that is in February. So it opens on February 1st, closes at the end of the month. So watch for that if you're one of our clients or if you are connected with a farmer's market located somewhere in our territory. This, again, is not a very competitive grant program. I've been on the selection committee for this grant program since it started, and it's very rare that we don't fund one of the grant applications. We've had some farmers markets that have applied like 3-4 times now, and so some of those we haven't necessarily funded again, but we try to spread it around if we can, but not highly competitive. So a few other comp-year grants that I'll mention are general use grant. This is available to organizations. They're typically nonprofit organizations, up to $10,000. The funds can be used for education, for things that enhance environment, could be for new technology, could be for things that enhance quality of life. This grant, it opens twice a year, so there's 2 application periods each year. I think it's like May and December, if I remember correctly. And so we've had a lot of nonprofit organizations that work in this space apply for the general use grant and get funding under that grant. We have a community building grant program. This is for brick and mortar projects. That's up to $10,000 as well. Could be for new facilities, new community facilities, or major renovation of a community facility. I think this one is on a continuous application cycle, and they put a certain amount of money into that pot every year, and when it's used up for the year. The Rural Feasibility Study Grant Program, that's up to $5,000. That's for feasibility studies that will ultimately result in economic development activity in the local community or maybe a new community facility. And this feasibility study grant money can be used for market research, for financial analysis, business plans, other things like that. In addition to these grants, we have grants for emergency responders. We have grants for agricultural education, for county fairs, and a few other things I'm probably forgetting. And then we do some one-off funding too. So if you have an idea for something, contact me and we'll figure something out. All right, any questions on the grants? All right, if not, we'll talk a little bit.
Sorry.
Oh, I'm sorry, go ahead.
Sorry, Paul, just really quick. Are these grants available like only once? So like if you apply and you get it, you can't apply again. Yeah or no?
No, you can apply again. Yeah, we've had some organizations that have gotten funded a couple times under these other grant programs that I just talked about.
Okay, awesome. Thank you.
Yeah. All right, I'm going to talk a bit about applying for a farm loan. And I encourage people to get prepared early. So, if you're thinking about applying for a farm loan next year, now's a good time to start getting prepped for it. Number one is to build and maintain a FICO score of 670 or above. That's your credit score. That's not a hard and fast rule. Like in our emerging markets program, our microloan, we actually don't use credit score as part of our underwriting criteria. That was one of the things that we built into that program, is we want to give ourselves the flexibility to write a loan to someone who maybe has no credit history at all, or maybe they have some wrinkles in their credit history or something. But 670 is sort of a rule of thumb. That's the low end. If you're below 670, you're going to have a harder time getting a loan. If you're above 670, you're going to give yourself an edge. Pay down credit cards, pay down student loan debts as much as you possibly can. You want to achieve a positive net worth on your balance sheet. So when you take all of your assets, everything you own, total it all up, and then take all of your liabilities, everything you owe to somebody else, that's a positive number, that you're not underwater. File a Schedule F. Schedule F is the federal the part of the federal tax return that where you record your profit or loss from farming. File a Schedule F as soon as you can. And I'm going to talk about FSA loan programs here in a minute, but FSA has some fantastic loan programs for beginning farmers. But you typically have to have at least 2 years of farm management experience. And the easiest way to establish that farm management experience is to have a Schedule F on your tax return. So if you have a couple of years of Schedule F, it's going to help you a lot when it comes time to buy a farm. You can file a Schedule F even if you don't have a whole heck of a lot of farm income. So maybe you've got a few hives of bees and you're selling some honey. you want to start filing Schedule F because you want to establish yourself as a farm manager. Build up cash reserves. You can never have too much cash, but you can often have too little cash. So you want to have some cash set aside. You may want to think about taking a small farm operating loan early in your farming career, even if you don't necessarily need much money, or maybe you don't need to use it at all. You just set it up and you never tap it. It helps you build a commercial credit history. So, 3 years from now, when you're ready to buy a farm, if you've had an operating loan with us for that period of time, and maybe you've used it a little bit and paid it off right away, you've established a really positive credit history. It's going to make it a lot easier to get a farm loan when time comes. Non-farm income is a strength. Sometimes people will ask me, well, I've got a non-farm job and that's where most of our household living is coming from. Is that going to be a problem if I'm applying for a farm loan? No, it's not. It's household cash flow, and that's a positive thing. If you're applying for an FSA loan, you do have to have enough farm income to cover the loan payments, gross farm income to cover the loan payments. But otherwise, non-farm income is definitely a strength. What your lender is going to need for a loan application is going to depend on the lending institution, on the type of loan that you're applying for, and the size of the loan that you're applying for. So if you come in, you're applying for an operating loan, I'm probably not going to ask you for tax returns. I'll ask you for a balance sheet and a profit and loss. If you're applying for a real estate loan, I'm going to definitely ask you for 3 years of tax returns. I'm going to want to see an offer to purchase. I'm going to ask for some other information too. So it really depends on the size of the loan, the type of the loan, and the lending institution. Current balance sheet or a personal financial statement that lists everything you own, everything you owe, that's going to be a minimum. Everybody's going to want to see that. It doesn't matter what lender you're talking to. It helps to have a projected profit and loss or a projected cash flow. Those are different things. I won't get into too much detail on that today, but if you have a projection for at least 1 year, that's going to be helpful. If you've got historic P&Ls or cash flows, that also be really helpful. A very simple business plan. You don't need a 20 or 30 or 50-page business plan. If we ask for a business plan that's in writing at all, it could be 2 or 3 pages. It doesn't have to be anything really extensive. We just need to kind of have an idea of what your plans are. A lot of times people don't even have their business plans written down. We just talk it out, but it does help to have something in writing. It doesn't have to be long. And then you may need 3 years of tax returns depending on the lender and the type of loan. This is what a balance sheet looks like, a typical farm balance sheet. Assets, that's anything that you own. So it could be cash in your pocket. It could be money in your checking account. It's livestock, it's machinery, it's vehicles, it's real estate, all those things. And then the liability side, that's everything you owe. And that's any principal that you owe on loans, or if you have a property tax bill outstanding or a credit card bill, all that sort of stuff shows up on the liability side. We just take the assets minus liabilities. It gives us net worth or owner's equity. Kind of tells you how much do you own of all those assets that show up on your balance sheet. And I'm happy to share balance sheet forms. If you need a balance sheet form, I've got a number of different ones. And I typically share a bunch of different ones with farmers, and they can pick the one that fits their situation the best. This is a cash flow projection. It's really great to have a month-by-month cash flow projection. And I don't always get them, but it really helps to be able to see when is cash coming in, when's cash going out, how much cash are you going to have left at the end of the month. If you're thinking about taking on a new debt, are you going to have enough cash coming through to make those loan payments without cutting yourself short on family living and that sort of thing. So the way you read this, we start in the upper left-hand corner. This is a farm that January 1st of the year, they had $10,000 in the farm checking account. You go straight down that column, they had off-farm income of $8,300, so pretty significant off-farm income for this family. And then you continue on down. If they had any farm operating expenses, those would all get paid out during the month and would show up here. You get down towards the bottom, they've got principal and interest payments, so they're making mortgage payments probably on a farm, 1985. They're taking $5,000 out each month for family living costs. So the amount of cash that went out during the month was $6,985. They started with $10,000. They brought in $8,333. They paid out $6,985. They ended the month with $11,348 in the checking account. And then that starts the month of February. And it just kind of follows all the way through the year. We're watching that ending cash balance, the bottom line number. We don't want that to ever go negative. If you run this projection out and it's negative, then we want to come up with a plan for how we're going to deal with those months when cash flow is negative. Is that where you're going to tap an operating loan? Do we need to change up the enterprises so that you've got cash coming in different months so that it covers you during those months shortfall? Is it bringing in more off-farm income? Is it rescheduling debt or something like that, or paying your bills in a little different cycle? So by going through this exercise, it really helps us avoid getting to the situation where you're sitting down, you're paying the bills, and all of a sudden you're out of money and you've still got a stack of bills to pay. That's really the point of a cash flow projection like this. This is a little spreadsheet. You can download this off our website or send me an email and I'll send this to you. So how does a lender make a loan decision? Well, anytime you hear a lender talk about lending, they're going to talk about the 5 C's of credit. And that's character, capital, capacity, collateral, and conditions. And I'll mention each of these or go into a little more detail on each of these individually as we go along here. And put those 5 C's together, and that's where you make a lending decision. So the first C is character. That includes credit history. This is where we're pulling a credit bureau report. It's looking at your experience managing a farm. It's the education and training that you've got to run a farm. It's your skills, your attitudes, your past work experience, your reputation, all that sort of stuff. A lot of it is pretty subjective, and then some of it's very objective. It's coming from your credit report. The second C is capital. This is where we're looking at the balance sheet, and we're looking at how much do you have available for a down payment. Do you have other collateral available if you're taking a loan and you're maybe a little short of cash? Do you have other collateral that you can pledge so we can lend more money to you to buy what you need to buy? It's looking at the overall leverage, so looking at your net worth, your equity position. It's looking at your working capital position, so current assets, cash, and anything that's going to convert to cash or it's going to be used up on the farm within a year's time versus anything that's due now. Any bills that are due now are going to come due within a year. That's working capital, and we look at that. We look at interest rate sensitivity. So if rates go up, is this going to sink your business? We're looking at whose investment is at risk. So we want to share that risk. So we don't necessarily want to fund 100% and that sort of thing. If you've got weaknesses on your balance sheet, they can be mitigated by strength somewhere else. So maybe your balance sheet isn't very strong, but you've got an 810 credit score. That's going to offset a lot of weakness on the balance sheet side. The third C is capacity. This is where we're looking at cash flow. How are you going to repay the debt that you're taking on, that you're proposing to take on? Is it cash flow from the farm? Is it cash flow from other sources, non-farm income? That's where we like to see that month-by-month cash flow projection. We want to see detailed assumptions to back up the projection. So whereas, when you've got income in your cash flow projection, how did you arrive at the income that you're putting into the projection? And same with expenses. If you're already in business, the cash flow should really be based on your history as a business, as documented on federal tax returns. This is sometimes I'll get into situations where someone's buying an existing business, and the business sort of operates on 2 different sets of books. They've got their cash records, which don't necessarily get reported to the Internal Revenue Service, and then they've got their tax records, and those 2 things should match. And sometimes they don't, but I won't go too deep into that. So what are we looking for with cash flow? We want to make sure that you've got enough cash to cover all the operating expenses for the farm, all of your existing loan payments, plus any new loan payments you're planning to take on. We want to make sure there's enough cash to cover family living costs and adequately cover family living. We don't want you to give up your health insurance because your loan payments are putting too much of a burden on your cash flow. You have to make income tax and Social Security payments. We want to build up working capital reserves, kind of a rainy day fund. We want to have enough cash to put towards replacement of stuff that's rusting and rotting and wearing out on the farm, machinery and buildings. And then once we have that, we would like to see a 15% cushion over and above all of that. Just if something goes completely wrong, like last year with the drought, or this year with flooding early that maybe prevented crops from getting in the ground, that sort of stuff. The fourth C is collateral to secure the loan. So we look at a loan to value ratio. Let's say you want to buy a new tractor and it's $25,000. We may loan 70% of the value of that tractor. We won't loan 100% typically. We will under our emerging markets program, but we typically don't because that collateral is securing the loan. In the worst case scenario, if you don't make your loan payments, then the collateral is taken to pay the loan off. We look at the quality of the collateral. Generally, the collateral value is based on an appraisal of some sort. A lot of times it's what we call a desk appraisal. Gather the balance sheet. You've got a list of your equipment. You've got the market values of all of your equipment listed on your balance sheet. And I'm generally going to take your word for it. I'm not going to, if you say your tractor is worth $20,000, I'm not going to say, no, I think it's only worth 18. I'm going to go with your number. And then finally, the fifth C of credit is after we've looked at those other 4 C's and we've decided, yeah, we're probably going to make this loan. We're going to have some conditions of loan approval. It might be if we're financing real estate, we have to have an appraisal and we have to have title work done. So those will be conditions of loan approval that we get those completed. We may need insurance. So if you're buying a property and it's got buildings on it, we're going to ask you to have property and casualty insurance in place while the loan is in place, so that if you have fire and one of the buildings burns up, that you've got enough to cover it. With our Amish clients, I have a lot of Amish clients, we'll use Amish aid in lieu of traditional insurance, and that's fine. Title insurance, evidence of lien, we're doing lien searches typically. Loan guarantees, if we need to have a guarantee on the loan by USDA, that'll be a condition of approval. Who's signing the documents? If it's an LLC, we have to see the LLC documents so we know who's got the right to sign on behalf of the entity. Okay, that's it on that part. Any questions on that? All right, if not, we'll talk a little bit about other lending options. So, I've been talking about traditional lending. I'm with the Farm Credit System. The Farm Credit System, like I mentioned right at the start, we're a nationwide network of farmer-owned cooperatives. Our system started back in 1916. It was actually started by the federal government because farmers at the time didn't have access to reliable, affordable credit. And that's still the basic mission of the Farm Credit System, is to provide reliable, affordable credit to farmers. Our network, and there's no federal money in the system anymore, by the way. The last time we had federal money in the system was during the farm crisis of the 80s, but that was all paid back with interest. We're the largest farm lenders in the United States. So if you look at all of the farm debt in the United States, the Farm Credit System holds between 40 and 45% of all of the farm debt in the country. There are three farm credit institutions that cover the state of Wisconsin. Compeer Financial, we're in about 2/3 of the state. We're kind of the southern part of the state and the western part of the state. Ag Country is kind of in the central part of the state. They're like Stevens Point, Wausau area. And then Greenstone serves the eastern, northeastern part of the state, kind of Green Bay area, I'd say. That's the Farm Credit System. Commercial banks hold about 30 to 35% of all farm debt in the country. So you take all the banks together outside of the Farm Credit System, and they're about 30 to 35% of all farm debt. We've got some really good community banks that serve agriculture. So I'm not knocking community banks. There are some really good community banks. There are some credit unions that do lending to agriculture that are really good and really competitive. Community development financial institutions, CDFIs, like Wisconsin Women's Business Initiative Corporation, WIBIC. They've got a farm loan program. They tend to be pretty small loans, but they can work with folks that maybe we can't, like somebody who's had a bankruptcy or foreclosure or something. CDFI often can work with folks in that situation when we can't.
Hey, real quick,
USDA
Paul,
farms. Oh, sure. Yeah.
Is there a convenient list of those CDFIs that we could get to? Or is that very local?
Yeah, there must be a list someplace. I don't know how many there are in Wisconsin, to be honest with you. I've worked some with WIBIC, so I'm
Okay.
most familiar with them, but they're good institutions. Yeah, they get money through the U.S. Treasury. They've got a conduit directly to the U.S. Treasury. And they're in CDFIs, their loans are they have to be paired with technical assistance. Their interest rates are a bit higher than ours, but I think it's well worth it for the amount of service that they provide to their borrowers. It's worth the extra interest rate. And they also do, like, I know Wibbick does a lot of educational programs that would be really helpful for any business owner, like programs on QuickBooks and business planning and that sort of stuff. And they typically don't even charge anything for their programs. So CDFRs are great.
Yeah, sounds amazing. And also, we had a question from Andy a little bit ago, waiting for a spot to squeeze it in. But how do
Sure.
farmers go about getting into the emerging markets program? Do they contact you directly?
Yeah, they can contact me directly. I handle Wisconsin. My colleague Sai Tao covers Minnesota and in northwestern Wisconsin. And then we just hired a new loan officer in Illinois. So I had been covering Illinois too, but now we have Sarah Horner who's covering the state of Illinois for us. But contact me and I can connect you with my colleagues.
Great, thanks.
Yeah. USDA Farm Service Agency is a great option, especially for beginning farmers. They offer direct loans to farmers. They offer loan guarantees to lenders. So if you hear about an FSA guaranteed loan, you don't apply for a guaranteed loan through FSA. You apply through your lender, and then we turn around and ask for the guarantee from FSA. Where we work with FSA the most is on the 54550 program, which is the Beginning Farmer Down Payment Loan program. Under that program, a beginning farmer only has to have a 5% down payment. FSA will finance 45% of a real estate purchase right now, I think their interest rate went up a little bit. It's at 1.75% on a 20-year fixed rate. Had been 1.5% for the longest time. The fantastic rate, 20 years fixed, which is awesome too. And then we finance the other 50% on a 30-year fixed rate, but it's a reduced interest rate. We have a little bit of an interest rate reduction for beginning farmers. And then if we ask for a guarantee on our loan, we can cut another 0.5% off the interest rate and lock that for 30 years. So we do a lot of beginning farmer down payment loans with FSA. We're fortunate in Wisconsin. FSA in Wisconsin is better than FSA in any other state. I've done a lot of lending in Illinois. I do some lending in Minnesota. Wisconsin FSA is head and shoulders above the other states, especially, and that's not knocking the other states. They're good folks too, but FSA here in Wisconsin is really, really good, and especially for farmers who are doing things outside of traditional corn and soybean production. FSA in Wisconsin is very willing to work with farmers who are not growing commodity crops. So I can't say enough good about FSA. They will do direct loans without an ag lender partnership if a farmer can't qualify for commercial credit for one reason or another. They'll offer loan guarantees. So again, we ask for the guarantee and get the guarantee from FSA. They typically charge a 1.5% guarantee fee. So we don't ask for guarantees if we don't need them. However, under that 54550 program, they waive the guarantee fee. And under that program, then I can knock 0.5% off the interest rate on our loan if we have a guarantee. So I always get loan guarantees on a 54550. I can save the borrower 0.5% of interest, and it doesn't cost them anything to put the guarantee in place. If you default on a loan that's got an FSA guarantee, it doesn't mean that the loan goes away. It just the loan obligation changes from us to FSA. There are some private for-profit, nonprofit lenders in this space. People for farmers who are marketing direct to consumers, doing something value added or regenerative or organic farmers. Steward, I'm sure many of you have heard of Steward or Mad Capital or Iroquois Valley Farmland REIT. It seems like there's a new lender like this starting up almost every week. You want to look for years of experience in farm lending and the likelihood that they're going to be engaged in farm lending years from now. You know, a lot of these are new startups. They're funded by investors, and investors are notoriously fickle. If the farm economy takes a downturn, they could be gone as quickly as they came in. So you have to be really careful if you're working with an unregulated lender. And these are unregulated lenders. You know, commercial banks have a regulatory authority that they report to. We have a federal regulator that we report to make sure that we're following sound lending practices, and we're not setting our borrowers up for failure. And if a borrower gets in trouble, there's a set of borrowers' rights that kick in so that we can't take adverse action against someone without giving them every opportunity to work things out. An unregulated lender doesn't have to comply with any of those things. So you have to be really careful. Not that there aren't good ones out there, but you have to be careful. What about other financing options? Well, there's land contracts, there's contracts for deed. Some counties or municipalities have revolving loan funds that you might be able to tap. Crowdfunding could be an option. Family and friends with loans or with an equity infusion. Sometimes we'll need a little help. I actually just talked to a guy today. He's a young farmer. He's buying a farm under the 54550 program. He's a little short of the down payment. I talked to his father about providing him with an equity infusion of some sort so that he is able to come up with that 5%. So there's a lot of different options. I want to talk a bit about our tax lease program. It's a program that's very, very unique, and we call it a tax lease. It can be used for construction of a new building, for purchase of equipment or of vehicles. We do it for grain storage, renewable energy infrastructure. We can do a lot of different things under the tax lease program. Under the tax lease, we actually own the building or the equipment or the vehicle, and we're leasing it to our client. Seems a little strange, but there's some pretty significant advantages to the program. Number one is that there's no down payment required. So like if you were putting up a building, and I'm going to go through an example here in a second, if you're putting up a building, you may have to come up with a significant down payment in order to construct that building. If we do it under a tax lease, there's no down payment required. If you're constructing a building and we do it as a construction loan, there's going to be payments that need to be made along the way. At least the interest has to be paid along the way during the construction phase. There are no payments required until the building's put in service on a tax lease. We have to do an as-will-be appraisal if we're doing a construction loan and you're going to own the building. We don't have to do that under the tax lease program because we own the building. Whatever it costs, we just pay the bills. The payments on a tax lease are tax deductible as rent while the lease is in place. So it's a true lease. It's, you're leasing, the IRS looks at it as a lease. You can write it off as rent on your tax return. At the end of the lease term, then you buy out the remaining residual value, typically around 15% of whatever the original cost was. And then you own the building or you own that vehicle or that piece of equipment. Even though it's a lease and we consider it rent and the IRS considers it rent, as you're paying your rent, you're actually building equity. We call it net investment. So we don't call it principal, but you're paying down a net investment during the lease period. So when you get to the end of the lease term, you just have 15% to pay, and now you own 100% of that building. The lease can be converted to a loan at any point too. So if you decide, I don't really like making the lease payments, I'd rather have a loan, like to take the depreciation on the building or whatever it is, you can convert to a loan whenever you want. And here's an example of a client I worked with a couple of years ago. It was an Amish machine shop. He was operating on his dad's farm in a really low, smoky, dark, miserable place to work. He had really outgrown that facility, wanted to build a new shop. He owned a piece of property and he wanted to put the shop on the property that he owned. He had a mortgage on that property with a local bank. Talked to the bank. The cost of the building was going to be $200,000. The bank did an as-will-be appraisal. So what the building would be worth once it's constructed and put into service. The as-will-be appraisal said the building would be worth $150,000. It was going to cost $200,000 to put up, only to be worth $150,000 when it's completed. And that's pretty typical on a commercial building. So it sounds weird, but it's true. That's kind of the way it works. And then the bank said, well, we'll loan you 70% of the appraised value, of the as-will-be appraised value. 70% of that is $105,000. So this gentleman called me and he explained this whole thing. He said, is that typical? He said, I saved a down payment, but I didn't save $95,000. But now I'm looking at taking out the bridge crane I was going to put in the building. And if I do that, then I'm going to lose a contract that I had lined up. And he said, I just don't know what to do. I said, yeah, that's typical. If we did a construction loan, we would do it exactly the way the bank did. But we have this tax lease program. explained it. He decided to do the tax lease. The building cost $200,000. We paid all the bills as the construction was going along. We even hired his company to do some of the construction. His guys put in the bridge crane and stuff. And we paid them. Compeer paid them for their work on the building, even though the building is for him. Got the building put together. Here it is. You can see a picture of it. Those lights, that's not, it's owned by an Amish person. Those are not electric lights, even though it looks like fluorescent lights. Those are Daystar skylights. So they're skylights that magnify the light. So they got this beautiful, bright, pleasant shop, great to work in. So much better than their old facility. They can work on equipment like this soil shredder here, which I financed for another one of my Amish clients. Just happened to be in there the day I was taking pictures. And the business grew 30% the first year they were in their new shop. So I've been doing a lot of these tax leases. I've done some Amish organic leg length facilities and all sorts of different things, equipment and vehicles and lots of stuff. So that's what I've got. I want to turn it over to Dylan at this point. If there are no questions for me, and Dylan, you want to jump in and talk about your experience on lending and business planning and whatever else you'd like to talk about.
Yeah, and
Sure.
and real quick before we launch off into anything else, that that last subject is so fascinating to me. And Andy had a question about equity infusion. Does that mean co-signing? Is that the same principle there?
It could be co-signing, or it could be an equity infusion. Like I mentioned, this young person that's buying a farm and can't come up with the 5% down payment, just doesn't have that cash. And the father can't co-sign on that it's an FSA beginning farmer down payment loan. Under that program, every borrower listed on the loan has to meet the FSA definition of a beginning farmer. So the father can't co-sign on that loan. It only can be the farm couple signing for that loan. But they're short of cash, so they do need to come in with the cash. And it can't be, in that situation, it can't be a loan. It has to be a gift, or it has to be actual cash. And so I had a conversation with his dad this morning, who happens to be one of my clients too. And we were talking about how we can get the cash to the son and his spouse to buy the farm. And it's probably going to be a contribution of some cash. He may buy a piece of equipment from his son, and I'll finance that for the dad. Maybe using his operating loan, technically not a approved use of an operating loan, but one way or another, the cash will get to the son, and it won't be a loan, or it won't be a cosign.
Great, thanks. Okay, back to you, Dylan.
Yeah, great. Thank you. I think Paul did a really good job of providing a comprehensive overview there. I will jump in that from our perspective. So my wife and I own Circadian Organics, which is our farming business, and then the brand, as Paul mentioned, that we've been building is Driftless Seed Supply, which is a small vegetable and flower cover crop and native prairie seed company. And when we started Circadian Organics, we made a conscious effort to start debt-free, and we were debt-free for the first 5 years until we decided to buy a tractor. And that kind of gave me our first experience of shopping around to see what different options are out there. And so one thing I would say is as you're investigating options, take the time to do that shopping around. And if you've already put together the things like your balance sheet and P&L, profit and loss projections, and those kind of things, a basic business plan, you'll be providing the same information basically to the different banks, and most of them, different banks or lenders or whoever it might be, and most of them are happy to take it in whatever format you already have, even if they have templates that they suggest you use. And so it's worth that extra legwork because, for example, we checked with our local bank. I actually didn't contact Paul at that time with the tractor, but we ended up being able to get financing from Alabama Credit Union for 1.5% or something like that for our tractor. And so you just never know what's out there until you poke around a little bit. And that was actually something that the equipment dealer connected us with, because we had made the decision to go with a newer tractor. So that was kind of our first foray into debt financing, and it really gave me the realization that I was really afraid of debt. Because I had been spending 8 years paying off my student loans, and I didn't want any more debt, right? I know how hard and thin the margins can be in farming, and so we were really cautious of that. But we got to think about smart debt here and making strategic investments. And we had been renting a tractor from a neighbor for the first 5 years of our business, and it was totally inconvenient. And it meant that we were doing a lot of stuff by hand that would have been just far easier if we'd had the right implements. And so pencil those things out, and sometimes it can be worth making the big investments that you might need. You might need that debt funding to make work. And in order to pencil those out and really understand, you have to, again, have a basic business plan to know where you started, where you're going, and have some financial plans and projections in place, and understand what the benefit of something is going to be and what it's going to get you. And even if, like in our case, it's not like I knew, okay, I'm going to save exactly this many hours of labor if we buy this tractor, but we at least knew, looking at our farm finances, that we can make those payments. And there were some months where that's coming from a combination of farm income and off-farm income, but just make sure that you can make that work before you dive into that. And building up that financial literacy and business planning, there's a lot of good resources out there for that too. I think one that I would highlight is we took the Food Finance Institute course for kind of beginning farm finances. There's some great recorded webinars out there from O'Grain and Marble Seed and others, many of which Paul's a presenter on, just talking about basics. And there's the great Fearless Farm Finances book too. And so, yeah, there's a lot of good resources out there. Another thing that I've really been diving into in the last year is all the resources that are out there from the state, the Wisconsin Economic Development Corporation, WEDC, as well as kind of the smaller regional hubs like the Mississippi River Regional Planning Commission or Cooley Cap in our region. And they have a lot of great resources too. They often have folks who are there to help guide you through business planning and putting together basic financial projections. And a lot of times they'll have small grants as well, kind of similar to the ones that Paul highlighted. I feel like as I've been poking around, I often see grants where the stipulation is you can't use it for your regular operating costs, but it's for kind of one-off things. Like in our case, we've been leveraging some of those grants to like invest some in our R&D program for breeding new varieties, or to now hearing more about the Beginning with Compeer program. We're hiring a financial consultant right now to help us switch from a cash basis to accrual accounting method. And so that's a great way for us to it's going to help us be a more sustainable business. And so it's a good case for Compeer, since we're one of their clients, and it's a great fit for us. And so, yeah, finding those little one-off grants, I feel like a lot of times food co-ops will have little micro grants, and sometimes those can go to pieces of equipment. So you just never know what's out there, and you really got to poke around. And a lot of times those economic development folks will be able to connect you to those resources that are out there. And also some of them might have their own revolving loan funds. So it can be nice to pair different sources of capital. So as we're growing our dripless seed supply business, we realized that we needed to expand the debt that we had to get us through one more sales year, because we're producing 3 to 4 years of inventory in a given production run. And so it just takes us a while to get up to speed where we're turning over as much inventory or selling the same value of inventory that we're bringing in. And so we needed, we have this one more gap to get through. And instead of just going with Compere, we decided to have kind of a stack of capital where we're applying with Compere for an expansion, but we're also applying with the Mississippi River Regional Planning Commission's CMV Growth Fund, and found a private investor who was willing to do an unsecured low interest loan. And all of those things will make us a more competitive applicant for working with Compere or a different traditional lending agency. Let's see, what else? I made myself some notes here as Paul was talking. I wanted to mention that one thing I really love about working with Compere is that once you have a loan agent, that's your loan agent. And so you can really establish a relationship, and someone who can get to know your business and understand where you're going. And as Paul mentioned, one of those C's is character, is the person they're lending to. And so establishing that relationship is really important. So some of the other things that Paul touched on, like weaknesses of balance sheet, like if your liabilities are outweighing your assets at a given time, or maybe months where you're looking at negative cash flow. I just wanted to encourage folks that those are things that you can overcome. We both, the co-founder and I, with Driftless Seed Supply, have a pretty good personal balance sheets, or not huge or anything, but at least in the positive. But right now our business is in the red because we're in our second year, and again, our production costs outweighed our initial sales. But because of the way we're getting creative with our financing, being willing to personally guarantee that loan, and really having a good growth trajectory and a strong brand, there's ways to overcome those things. And our cash flow is highly seasonal, right? We're dependent on the seed sales season, which is even tighter a lot of times than the fresh market sales season. And so we have expenses all year long, and in the late fall we're ordering a lot of packaging and cost of goods stuff, and we don't really see income until the following spring, and then it's like a big quick spike of income and then pretty flat again. And so doing things to get creative, where we're really leaning into garlic production and cover crops, so that we can have a little spike in the fall of income, and getting creative with that, or other sources of income, helping out different businesses if it's in your wheelhouse in your off season. Let's see, what else? There's another resource that came to mind is things like Kiva microloans, or like a WeFunder equity crowdfunding platform. Again, just creative ideas for how to raise capital. And even though you're, as a farm business, people don't think of taking on outside investment for equity. Don't rule it out necessarily, especially if you're building a value-added brand. That can be something that angel investors who care about agriculture might be really interested in. Just be cautious and do your research of we learned basically at the last minute, right before we were about to take on equity, that it would have discounted us from a producers only grant that was going to be really important in our growth. And so, just make sure you dot your I's and cross your T's there. Let's see, what else? I think we started as a direct to consumer business, and then have moved to, except for the retail sales of our seed, a lot of what we do, a big bulk of our production, is on contract for other companies. And I think that's I can't speak to Paul's underwriting process, but certainly when we've talked to folks, having contracts that you can secure for wholesale, and providing kind of that foundation income is super important. And so it was a great way for us, pairing with LFPA, where we have this contract, and some sort of nothing's a guarantee, because this year we had tons of flooding, but it's about as much of a guarantee as we can hope for. So yeah, I think I'll leave it at that. And yeah, I don't know if anyone has any questions.
There, Dylan, I've got a question for you.
Sure.
Um, you mentioned you just mentioned the importance of like contract growing, and I know that seeds is maybe uh, different from like other farm operations, but yeah, wondering what other contract options are out there for farmers. Do you know of stuff like that that's available?
Yeah, some. So I think sometimes like produce wholesalers will be willing to provide a contract. So even if you're not, and I should differentiate because there's like contract production for somebody like a cannery, where or one of the meat companies where like they own a product as it's being produced and you're just a contract producer. And then there's like basically agreement to buy contracts, which is kind of like what LFPA is and what our seed production contracts are. But if you're a fresh market farmer, that's when we started doing contract seed production. So hit us up if you're interested in that. And either like we might have some options for folks to try their hand at seed production or be able to connect you with other small seed companies. And then I think, I'm not sure if they do anymore, but what's his name? Par's Produce used to sometimes provide agreements to buy certain products. I think, even if you don't get that like hard agreement, a signed agreement, like having a soft commitment from like just talking to a produce buyer at a store. The more you can know your market before you plant the seeds, obviously the better it is for that business planning and financial planning, and really helps you like put some hard numbers to it when you know the price that you're going to be able to get.
All right, that's really helpful.
Yeah, also Dylan, and when you were talking about the time that you spent putting together your business plan and your projections and all, um, I wanted to remind people that are tuning in also that land access navigators through the regional land access hub can help producers with these forms as well. And you can connect to a land access navigator through Marble Seed if you're needing that help. Plus, also, I wanted to ask Dylan, how often do you return to your cash flow projections and your business plan and tune them up,
Um,
or
the
see where things
yeah.
went off the rails, or whatever it is that you
Yeah,
do?
exactly. I mean, like that's changed a lot over time. Like in the first handful of years with circadian, we didn't almost at all. But increasingly as I go on, I just find it like really, really useful to have as many touch points as that with that stuff as I can. And the business plan, um, I feel like that's kind of on an as needed basis. But I think certainly like anytime you're gonna apply for more um, funding from somebody, or you're going to let's look for equity investment, is shore that up, like go back to it, make sure it's up to date. And once you have some traction and track record, like that is just going to speak a lot more strongly in a business plan. That's really worth doing. And then also it's worth keeping that updated when you have a chance, because a lot of those like micro grant programs, it's just going to make that application process so much easier. And we went from a like, I don't know, 3-5 page, maybe it was 8, kind of business plan brief that I originally put together when we were working with Paul to apply for that initial debt funding, to now as part of the Rural Business Innovation Lab with Community Economic Development Associates, which is another one of those like great nonprofit programs that's out there that we've been using to help hone our business. We've been kind of drilling into like things like our operations plan and our marketing plan and all that, and putting that into the business plan. And now we have this like monster 50-page document, which is like, whoa, do you even really need that? But what I've discovered is now I can take that full business plan and I can feed it into Chat GPT and be like, answer this grant application or summarize it for just this. And when it has that much material to work off with your voice already in it, it's like an amazing tool. And then for our finances, with Circadian, I was doing that quarterly because we had other business owners, and it was my responsibility as one of the LLC members to be reporting back to our other business partners how we were doing. And now with Driftless Seed Supply, I do that monthly. I do our kind of reconciliation and go through and just doing that homework of comparing your actuals versus your projections is like, there's so much to learn about that, and understanding the seasonality of your cash flow. And I feel like it's going to be a multi 3-year journey before I feel like we really have a solid handle on that for this new business of Driftless Seed Supply. But there's it's a great thing to do. And then when it comes time for taxes, you're like, wow, I'm already done. Great. Hand it over to the CPA and got all my reports ready. And so it's just a great practice. I think it's like, it's like keeping the records that we do for organic certification. Is like, you can do it all at the last minute and cram and putting it together. But it's such a good business practice to just like stay on top of that stuff, and makes it so much less of a like anxiety inducing experience like it was early on for us. If we like put these systems in place where I'm like, all right, at the end of the month, or the first or the very last day of the month, whatever comes on my work day, the next work day, depending on where the weekend lands, like I'm just going to use that day and make sure I go through and do our reconciliation and generate our reports. And we use a free accounting system called Wave, but we're going to migrate over to either QuickBooks or Xero here pretty soon. But like there's some free alternatives if you don't want to pay for QuickBooks, but having a system like that can help you quickly generate different types of reports and like investigate your cost of goods and stuff is huge and really helpful. And I would say like one other thing in terms of like one of the farmers I really look up to, Kat Becker at Cattail Organics, told me one time that they try and do like a cost accounting of a given crop, because it's so hard for us to like as farmers to tease apart the costs of like how much labor is for this crop or this crop. And it's like you can kind of get lost in the record keeping, and it can quickly balloon to like where you're spending so much time trying to track things that it's kind of inefficient. So Kat, mentioned that every year they try and track one crop. And so kind of like pick your battles, but over time, if you can figure out what crops are profitable for you and what aren't, and compare that to what you like growing and what you don't, you might learn some interesting things about like what's, maybe that crop that you hate growing, maybe you never need to trellis a tomato again because it just hasn't been as profitable as you thought it was, despite what everybody says. So yeah, pick your battles, and then try and do a thorough job of what you can. And there's some other good tools out there too, like the Veggie Compass, and I think there's some other crop and livestock categories that they've put those tools together for now. But yeah, some other good options there. Well, I'm grateful to be for the opportunity to be a part of the webinar here, and it's been great working with Paul. I encourage folks to reach out and have a chat with him, and Paul, and if you get the right loan agent, like when I went back to Paul and was like, I think maybe we need more money, need to expand, and Paul was like, maybe you should think about equity financing, right? And so find someone who's going to be a good ally for your business too, and isn't just trying to milk you for loan interest. Like it can be really helpful to find different advisors, or like maybe there's even a family member who's retired and is down to help you put together some projections or whatever. And yeah, just find those people who are up for being an ally.
Yeah. And I'll say from my perspective, Dylan's been a joy to work with, and because he's on top of his numbers, he's monitoring this stuff constantly. You heard what he said, and from my perspective, it's so refreshing. It's very rare too, by the way. we talk about that first C of credit being character, and Dylan's like at the top of the heap there, and yeah, so it's nice to have somebody who gets the numbers, is monitoring the numbers, understands where their business is. There can be a tendency, when you're starting out and maybe your things aren't going quite as well as you'd hope they would. There can be a tendency to not focus on the financials and kind of put your head down and just stick to farming every day. And it's important to know where you're at and where you're going. And yeah, and he's been very creative with finding other financing sources, which is great, because it's going to enhance the success of his business, which is what ultimately we want to see.
Yeah, totally. And what I really appreciated, especially about this afternoon's talk, was just hearing how much more accessible Compeer and the partners around the farm financing programs are making actual, not just planning, but financing of a farm professionally so much more attainable and approachable, that I'm excited to start sharing all of this. And I think if I hear the explanation of a tax lease one more time, I might totally get it next time. It's brilliant. It's brilliant. And I can't wait to share that information with other farmers, especially when, people just on the verge of that breakthrough that I think this financing can make possible. So thank you very much. Both of you, I really appreciate you taking the time to help us out.
Yeah, absolutely.
Sure.
Hope you all have a great rest
Yeah.
of your week and weekend.
And before we all go, there is here in the chat a link to a brief webinar evaluation that we would ask everybody just take a few minutes to submit. It really helps us to plan and get ready for these events. Also, I wanted to share with everybody in this group another upcoming business planning event will be our November 4th Farm Business Decisions in-person event. It'll be way up north, but we'll be recording that one as well. But it's a Farm Business Decisions, Food Access, Wholesale, and Beyond. It's an interesting take on how you make these emotional and financial decisions at your farm. And when you're out there all alone doing it, and you hit log jams, and you hit these personal interpretations of business problems. They're helping us find ways to make the best decision possible. So there's a link right there to that event coming up. It's on the Wisconsin Local Foods, the WILFPA homepage. So we hope to see you all there. And thank you all, and have a pleasant evening.